And I'm Tony Kottenbrock. I'm the head of the Wholesale Sales Channel, and I'm going to introduce our guest. I would like to say I'm an expert, but the people joining us here today are much more of an expert on a daily basis than myself. But we do appreciate everyone joining, and I will start off by just announcing that if you did not know, hope you will know after this presentation, but we are a national non-QM lender. We securitize our own business. We service it. We're not selling these loans off to other people that are securitizing it. That does give us a little bit more flexibility. I'm sure that'll come up there during the presentation, but I think that's important to note. We want you to send us your Govy business. We want your conventional business. We want your jumbo business, but we also want you to know that we are a national non-QM leader. And we have the products to back that up. And that's what we're going to discuss today. But enough of that. I'll get into our guest. And I want to introduce Cecilia Estrada. She runs our national wholesale, or really as a company, she's a non-QM expert, business development manager. Then Sean Colvin. Mr. Colvin actually led all of wholesale sales in 2024 on non-QM. And I think you'll understand why when you listen to him on this call, but he actually just got back from our trip in Miami as an award winner. And then lastly, definitely not least, Jevon Staffieri. You're gonna have to say your last name. I'll never get your last name right. I've only known you a few years now, but he is a big time expert for us. In fact, he deals directly with our parent company, has a lot of participation in our programs. And he is actually the one overseeing our entire underwriting staff and a separate underwriting group that underwrites our non-QM business. So we don't overlay that in with conventional Govy. We have experts that do this every single day. So I'm going to go ahead and just hand off the floor to Cecilia.
Thank you, Tony, and welcome everyone. As Tony mentioned, yes, we want to make sure that everyone is aware that we're not just a full suite lender when it comes to agency government products, but we are also a non-QM lender. And we've got a lot of great products to share with you today. So we're going to go ahead and get started. Now, one of the first things that people want to know is how do we categorize our non-QM products, right? So we really do it the simplest, easiest way that we possibly can, which is just looking at what the borrower has to offer in terms of income. That's usually the big determinant when it comes to are they eligible or are they ineligible, right? So we've got a regular type of borrower who works at a company. They're going to be W-2 and pay stub. That's going to be a traditional full doc loan. Yes, you can do full doc loan on agency products, on your regular loans, right? But you're also going to have that availability on non-QM. And we have a product called SmartEdge, which will be able to help all of those borrowers who are going to fall under the non-QM niche, but are also full doc. Then we've got an option, which we call SmartSelf, for all of our self-employed borrowers, right? All of the borrowers whose taxes are not in line, who have a lot of losses, who maybe haven't filed taxes, who are just kind of trying to get up to date. They've got extensions and things like that, right? Businesses that cannot prove their income through traditional means, a P&L and taxes, we've got two options for them. We've got bank statements and we've got 1099s for contractors. Then we've got another option, which is completely non-traditional. It's called asset qualifier. Now, this one's a little bit different than asset depletion. It's got a little bit of additional quirks to it, but it's a great product. You will qualify on assets only. Last but not least is qualifying on your rental income. This is typically known as DSCR. So we've got two products for that one, actually. Okay, so these are the ones that we're going to explore, that we're going to go into and give you all the little perks and all the little features of them. So we're going to get started with our full doc product, which is our most commonly used product for conversions. So what's a conversion? A conversion is when you're already on an agency product, and then something kind of happened along the way that made you ineligible. So typical things that would happen is maybe the score dropped, or the debt ratio went over, or maybe the property is not eligible. So some of the properties that are ineligible are condos, right? Everyone knows we need to get a condo approval. But condo, if you want to make it warrantable, it has to follow Fannie guides, right? So if you fall outside of that realm, that's going to be a non-warrantable condo. That's where we step in and we say, okay, we know what Fannie requires. We've actually made extensions to that and we'll require a little bit less. So, less rigorous conditions to meet, right? Single entity ownership or the commercial space in the actual project, things like that, right? But most importantly, as of late, insurance deductibles play a really big role. So if you're not sure if your property is going to be warrantable or not, it's a great product to look at because we do allow different types of condos, including condotels. So that could be one of the things that brings you here. But we've made a quick little list of items that could possibly bring you to this product, even if you are full doc. So let's just say you are running your AUS, you get a refer with caution, you get a fail. That's where you want to step in and say, okay, wait, I know this is a good loan. So why am I getting an AUS ineligible? Go to non-QM. We are manually underwritten. So we're not looking at an AUS. Okay. Another thing is that a lot of people associate non-QM with higher pricing, higher rates. But actually, the pricing is not that different from what you see on agency. And for your borrowers that are at the higher LTVs, you're going to get that little surprise that we don't have PMI. So if your borrower is maybe a first-time home buyer and they're just putting the minimum down payment, maybe 10%, something like that, they're not going to get hit with PMI. So that could actually make your payment a lot lower on the non-QM loan than on your agency loan if you're comparing PITI to PITI, right? That overall bottom line payment is going to be a lot more affordable on a non-QM loan. So that's another reason to look at it. But there's a list here. You'll see that non-warrantable condos and condotels are listed there. One of the bigger things lately is also cash out. People want to do debt consolidation. People want to, get one payment and make it more affordable. So if they're looking for that, yes, they can do cash out as soon as 6 months of ownership on that property. They don't have to wait the 1 year that they typically would on an agency loan. And we've just increased our cash in hand amounts. Previously, we were at anywhere between $500,000 to $750,000. And as of yesterday, we actually increased our cash in hand to $1 million if your LTV is on the lower side. What that means is, yes, you can pay off a mortgage, you can pay off debt, and then the cash that the borrower actually receives on the CD can be $1 million. And I know there's a lot of borrowers out there that are looking for those higher cash amounts. I know Sean deals a lot with people that are doing cash out. Sean, I'm sure your borrowers are going to be pretty happy about that.
Oh yeah, I get requests for it all the time. So this is a magnificent guideline change that we have done as a team. So this is a really good one.
Yes, that's a new enhancement. Also, when it comes to AUS, it is grading everything on your application. So if the borrower did have a late, maybe on the rental side, right? If they're paying rent for where they live or on a mortgage that they currently have under their credit, if there is a late, that might give you a refer or a fail. Whereas on non-QM, if you do have a 1 times 30, which is usually what we call it, a 1 times 30 late, we're okay with it. We're willing to accept a 1 times 30 late. And we're also pretty lenient around other credit events like bankruptcies or foreclosures. Typically, if you're looking at bigger loan sizes, jumbo loan sizes, you need to have clean credit with no issues for 7 years. If you're looking at agency, it's got to be 4 years. With us, it's only 2 years since that bankruptcy discharge or the foreclosure date. So it makes it a lot more lenient and easier to qualify.
And I would just like to say that this is an incredible program when you're talking to the people in the jumbo space. Anywhere that you go, if they have one late payment, it's virtually impossible to get done. And I can tell you from personal experience, I've recovered a couple from utilizing this program. In addition, when you're pricing it out, always look at this program for second homes or investment properties, because they are non-QM products and they are our own. we're not subject to the agency hits that Fannie and Freddie put on there. So we're not subject to the 350, the 400 basis point hit for investment or second homes. This is a great product to check out for that. I've done many of them and say many loans and help loan officers win deals because of this program. Exactly.
Yes, you're absolutely right, Sean. We don't have all those additional LLPAs. So second homes and investments can actually price out better on non-QM than you would on agency. And if you take a look at that grid there on the right-hand side, for primary homes, you'll see we can do loans up to $3 million. So that'll definitely take care of that jumbo space. And that's on primary. On secondary and investments, we can go up to 2 million. LTV wise, on primary homes, we can go as high as 90%. So it is still able to take care of and handle your first-time home buyers that want a little bit more affordable down payment. And remember, this is a manually underwritten product. It's non-QM, it's non-qualified. So what that means is that if your borrower doesn't necessarily meet this grid that we're looking at, they don't maybe have that particular score, or maybe they need a slightly higher LTV, we can look at exceptions. And Jevon, our underwriting VP, is actually going to tell you a little bit about the more common exceptions that we look at on this product.
Yeah, I did just want to say, hi, everybody. Thanks for joining. It is Jevon Staffieri, for the record. We do have the Q&A open, right? And I'm here to answer any underwriting questions you have there. So please feel free to use it. You got me for the hour. So I'll probably scroll through these as we get them. And Cecilia is going to give me some time to answer the questions as they come through. So feel free to shoot anything over there into here. Another thing I wanted to touch on, I know Sean touched on it about the $1 million cash in hand update, right? What's really cool about Newrez is we look at the exceptions we're making on a monthly basis on the non-QM product. And when we see a tall bar for one of those exceptions, I have the ability to review them with our parent company and make suggestions for, hey, we've been making this exception a large portion of the time. Let's get this implemented into our guides. So in the future, we don't have to do an exception. And this is a perfect example of that kind of in action. And we do it quickly and we update our guidelines pretty quickly. So about 30% of our loans from non-QM space close and fund with exceptions on them. So it is a high portion of the loans. So if you have a scenario and you're not sure, that's a Sean and your AE is here, right? Ping it to them and they have direct access to us and the underwriting team to get it looked at.
And exceptions are very simple to do. All we need is a 1003 credit report, and we have an exception form to fill out. And Jevon and his team are very quick. It's about a 24 to 48 hour turnaround time. We'll have an answer, and we'll let them know if we have a loan or not.
Yes. Yes. It's great that we have access to our underwriting team to do those types of exceptions. Even before you lock a loan, before you submit a loan, we can just look at the application, look at the credit report, and really get a sense of what the borrower has to offer, right? What the compensating factors are. And if it's a make sense deal, then it is something that we'll review and hopefully get you that approval on. And like Jevon said, about a third of our loans close with some sort of an exception, right? Anywhere between 25 and 30% of our loans. So that is a really good amount. It could be debt ratio, it could be LTV, score, credit issues, other things, right? But that's the beauty of non-QM, is that you have that opportunity to close even more than what you thought you could. All right. Okay, so we're going to get moving on to our next product, which is actually almost an identical mirror of our full doc product. And this is actually our bank statement product. This one we call SmartSelf, right? And this is the one where you can work with a self-employed borrower and use non-traditional documentation to get them approved, right? But if you look at that grid on the right-hand side, primary homes, secondary homes, investments, it's the exact same parameters that we have on our full doc product. So you get the same stuff. You get the same loan amount, jumbo loans up to $3 million on primary homes or 90% LTV. You get 85% LTV on investment properties. You get $2 million on those second homes and investments. So you can still get all that same stuff. Scoring, LTV, loan amounts is all the same. Those parameters are the same. But the thing that you want to focus on here on this product is you have to have at least one borrower who's self-employed. And that borrower should be self-employed for at least 2 years. If they are, then they are eligible for this product. And what we're doing is we're saying, okay, let's not use the taxes or transcripts or P&L, right? Because that's what you use on the agency side. Let's actually look at their bank statements and see if we can make heads or tails of those deposits. So we do have options to use personal or business checking accounts, okay, for that business. But additionally, we have an additional third option to say, okay, wait, if you're a contractor, if you're someone like a construction worker, a driver, maybe even a real estate agent, we can use your 1099 form to qualify you and use that income on there. Yes, we are going to look at an expense factor or ratio for that business. Traditionally, we use about 50% as an expense factor, but we've made it very, very easy to reduce that expense factor and actually give you more income. So we can use a CPA or tax preparer letter to actually reduce your expense factor. They don't have to provide a P&L. They don't have to show us anything that they've audited. All they have to do is state that the expense factor is a lower amount. And we can go as low as 15%, regardless of the business type that you have, whether it's a standard business or a capital intensive business. If you have that letter, we can reduce your expense factor to as low as 15%, meaning that you can use 85% of your eligible deposits. That's a lot of income for your borrower, right? So as long as they have that 2 years, they're eligible. But the other thing is that you can use all other sorts of income types, right? So what does that mean? That means if you have a co-borrower on the loan, they can use their pay stubs and W-2s. You can do full doc for that co-borrower. You can actually even use full doc income for your self-employed borrower. Let's just say they have a business, but they also have a side job. It's a W-2 job, right? As long as the self-employed business earns the majority of income for that self-employed borrower, then you can use the bank statement product, right? They can't make more money from their W-2 job. But you can also use, if they have SSI or pension income, you can use those award letters. You can use asset depletion for any assets you're not using for the loan. You can even use rental income, right? So you can still use everything that you're used to using, in addition to making it a little bit easier for that self-employed borrower to qualify, okay? And yes, we do look at NSFs. I know a lot of people ask about NSFs. We do look at NSFs. Typically, we don't want to see more than about maybe 6 days of NSFs in a year, right? But we actually just improved or enhanced that guideline where you can have unlimited NSFs on your bank accounts if you're using them to qualify, as long as your borrower has a 620 score or higher. Then you can have unlimited NSFs. We're not going to say, okay, wait, we need to look at this a little bit further, right? If they don't have that 720, they're lower, 700 or 680, it's fine. If they go above the 6 NSFs, then that's something we have to look in a little bit further and maybe look at an exception. Okay. But there's a lot of things that you can do here. And I think the biggest thing that it helps with is all of those borrowers who have the newer businesses that are maybe 5 years or newer. Typically, those are the borrowers that we see that have to use bank statements to qualify because they're still not done with just reporting everything on their business. They still have a lot of write-offs and things like that. So this is where it can really help. And this is actually our most popular product. Sean, I know that you use this one quite a bit. You want to speak on a little bit about how easy it is to submit those bank statements?
Oh, it's tremendously easy. I first want to say that there's a common misconception in the industry, and I talk to people all the time that people look at these non-QMs and they hear non-QM and they think subpar. This is anything but, especially these self-employed borrowers. They're usually really very, very well qualified, 740 FICO and above, great loan amounts. To get the bank statements analyzed, it just takes a couple hours. We just need 12 or 24 months of statements, some questions about the business, and we can have that back to you very quickly. And that income is good for 90 days that we will use, the underwriter will use when doing the loan. So there's no question about income changing or is there going to be a different calculation done? No. Once you have that calculation, that's what you can take to the bank. And I can tell you, since COVID, the common conversation I was having just after COVID is a lot of businesses took a hit. They didn't have a lot to write off to have on their tax returns, but now businesses are growing, so they're having more expenses, and this is a very typical conversation I'm having right now. Definitely will sell this one. We're seeing a lot of them coming in.
Yes. And I think the fact that we do allow you to still use whatever's left over, whatever asset you have left over in that account, even though you're qualifying through that account for income, we still allow you to use whatever balance is left over as assets for reserves. That makes it, excuse me, that makes it a double whammy, right? So you're able to not only use that bank account for income, but whatever balance is there, we can still use it as part of your assets. It's part of your down payment, your reserves, whatever it is that you need. So it is a really great product. Like Sean said, our underwriting team, our non-QM underwriting team, is actually going to do the review for you. So we don't expect for you to look at the bank statements and go through the deposits or anything like that. You're actually going to upload them into our system. Usually the most recent 12 months is going to give you the higher income. So that's usually what we recommend. But there is a small pricing concession or a little bit better pricing if you upload 24 months. But 12 months is usually going to be the better deal. It's less paperwork for your borrower also. And we will do the review for you. It's an actual non-QM underwriter. So like Sean said, once you get that income, it's ironclad. It's not going to be disputed later once you submit the loan. Okay. And yes, we do have a time frame, about 60 days, maybe up to 90. If you go beyond that, then we are going to need the more recent 2-3 month statements. But once you get that income done, if your borrower is pre-qualified and they're out there house hunting, you can rest assured on that income. It's not going to change on you later. Okay. And I'm sure Jevon has some comments as to some of the more common exceptions on our bank statement product, because we do get quite a bit.
Yeah, there's been a couple questions in here about exceptions, and maybe just touch on that overall about, what we consider for compensating factors on the exception. What I can say is, we're really looking at the type of exception it is for the compensating factors to correlate to that. What I mean by that is if it's a property related exception, for example, right? Reserves don't necessarily make sense for the exception. If it's property related, we're looking at the CU score, we're looking at the comps, we're looking at the LTV, versus on the opposite side, if there's a DTI exception, for example, right, we're looking for the compensating factors there of reserves being the number one comp factor there, as well as maybe additional income that we can't use to qualify, but would be used to support the higher DTI, a property that's maybe being sold after closing that we're already including in the DTI. That's another great compensating factor we use on DTI. So we're really trying to use common sense, right, in looking at the exception to figure out actual compensating factors that really correlate to that exception. So we're looking at it case by case. Standard count factors apply, but we really look at it for each individual loan. Another question that popped up through here is about, I think the question was using additional income in addition to the bank statement income, particularly if you have two borrowers, one W-2 and one is bank statement, that is fine. There can even be a case where you have one borrower that is W-2 and self-employed with a different business. We just require that the actual bank statement portion of the income is more than half, right? So we don't want a bank statement income of $200 a month in income, but the W-2 job is $10,000 a month. That won't work. We want the primary source of the income per borrower to be bank statement driven. So I think that covers maybe 3 of the questions I think that I've seen in here so far.
Okay, great. Thank you, Jevon. And
I do
another
sorry.
comment.
I do see a question. I'm sorry, real quick. I do see a question about the property manager for short-term rental. That is a case by case. I have done a couple before, but there's a couple things. Eric, if you want to reach out to me later, I'll be happy to go through that with you. That's going to take a little bit more time than we have today.
Yep, I think I could add to that, Sean. Generally speaking, right? A real estate individual, right? We get this come up a lot. The good thing to know, and I guess to keep it as easy as possible, I would say, is you need to have a business that we are going to be able to validate just like you would on a regular agency loan, right? So when we go to do our verification of employment, once the loan is in process, they need to have a business. They need to have Colvin Properties LLC for us to be able to validate. If it's a borrower with just having rental properties on the Schedule E of your personal tax returns and no business, it does not work in our bank statement product.
That was a good comment to make, because we do get a lot of real estate people that they're investing and they want to use that as a business. But correct, you have to actually have a business set up that we can verify and validate. And another common question that people always ask is, can we work with a self-employed borrower that hasn't had their business for the 2 years? So that, unfortunately, we cannot do. The 2 years is the minimum. We do need that. And if they have partners, they should be at least a 25% owner of that business, right? So if they have a smaller percentage, then we don't consider them to be self-employed. Okay, so the 2 years and the 25% ownership minimum, that is our baseline. We cannot go below that. Okay. And again, if you have any other questions, please pop them into the chat and we'll do our best to get to them. Okay, our next product is actually going to be our asset-based product. And this one we call Asset Qualifier. Now, this one is a great product, very underutilized. We are really starting to put a lot more people onto this, because I think before people just really had an idea that it's asset depletion, but it's not. It's actually so much more. You are fully qualifying on personal assets only. And the way that you want to look at this product is really to say, whether your borrower has income or they don't have income, this could really be a great path to getting your loan closed faster, quicker, easier, right? Which I know everybody loves. So the basis of this product is to ensure that the borrower not only has the down payment, which is a minimum of 20%, and after that down payment piece, after whatever they have to put at closing, down payment and closing cost, they should still have a minimum of $500,000 in personal assets. Now, those personal assets you'll see listed there can be a combination of many things, right? Anything that you have in your checking account, personal checking, savings, things like that. You can use 100% of that balance. You can also use 85% of your balances if you've got investment accounts, things like that, right? Like your Charles Schwab, your Fidelity accounts, stocks. Additionally, if you are retirement age, 59 and a half years or older, you can also use 401k or IRA. But if you're under that age, unlike asset depletion, you can still use it. You can use 50% of that balance, okay? So we allow you to use your personal assets no matter what, regardless of your age. It's just different percentages. So you're going to put all of those together and hopefully they tally up to at least the 500,000. If you have that 500,000, then what we're saying is this should be enough for you to pay your bills for the next 5 years. And it's got to be all your bills, right? It's got to be the new mortgage that we're giving you, your full payment, PITIA, right? Taxes, insurance included. It's also got to be all the payments that we see on your credit report. And additionally, we start with at least about $2,000 as a baseline for your personal items. Now, everybody has personal things that they have to pay, right? That are not on the credit report. So we look at that as well. We're not looking at an actual debt ratio, but we're looking at, well, we know you're going to eat out. We know you've got car insurance and cell phone payments and utilities and groceries and all the other little things that we don't see on the credit report. So we want all of that included. So we do the new mortgage payment, all the payments on your credit report, plus at least that $2,000. And if it's enough with that 500,000 to cover that for the next 5 years, then you've got a deal. Then you're eligible. So basically all you do is take your assets, divide it by 60 months, which is 5 years, and make sure that your monthly expenses don't exceed that. And if you have that, then you can do this asset qualifier loan. Now, it works really well for people that don't have their income to verify. For example, people that work on a contract basis, right? We get a lot of people that work in the sporting industry, they work on contract, and by the time they come to you, they do not have that 3-year continuance. So those borrowers typically do have a lot of assets put away because they've gotten bonuses and things, but they don't have the 3-year continuance, right? Or maybe the business hasn't been operating for the 2 years, but they've got personal assets. Or it could be the opposite. You could have a borrower that has plenty of income, right? Maybe they have a lot of businesses. Maybe they're giving you, 3 types of taxes and a many K1s. And you're thinking, wait a minute, I looked at that Charles Schwab account and there's like $2 million in there. So maybe I can make it work with just that. So what you can do is cut the red tape here, get rid of the income documentation, not have to wait for transcripts. You don't have to wait for VOEs. You don't have to wait for CPA letters or P&Ls. You can cut all of that out of the equation. And if you're not submitting income, guess what? You're also not getting income conditions, which make a really big part of the conditions on your approval. So you can possibly cut your conditions by about a third and only have to deal with like assets and your typical property stuff, right? So that's like
This program
to use the product. Go ahead, Sean.
Yeah, this program is tremendous right now. The pricing, if you're probably asking yourself about that, the pricing is even not much different from conventional. It's a little bit higher and very, very competitive. And it is very low documentation. We're talking about the most recent bank statement plus a bank statement from 6 months ago. And then there's also draw schedules for retirement accounts, but that's just pretty much about it. Where I've been seeing the greatest success in my customers, I've been advising them to go to money managers, financial advisors, anybody that handles people's retirement, because a lot of people are retiring right now. And I have a tremendous amount of these going on where the individual is just retired and their pension or their new Social Security income, it does not quite cover, what they need for the DTI of their new house. Maybe they're moving to Florida or whatever the case may be. And a lot of people are not wanting to sell their current property until they actually buy a new one. So definitely can't withhold the DTI for both properties. But they have like $1 million in their bank account. We make this very simple. If you contact your account executive, we have an income calculator. It's a simple Excel spreadsheet. If you punch in the numbers and the product says green, that it's approved, that's it. It's pretty much, you can take it to the bank. We just got to verify the assets and then we're good to go.
Yeah.
Very easy.
Yes, super easy product to use. I think it's a lot simpler than what people think. And like I said, it doesn't necessarily mean that your borrower doesn't have income or that their debt ratio was so high, so you need this product. Even if they do have income, you can actually express your way to the closing table by not using the income and only using the assets. Because again, you're cutting the time frame that you have to wait, right, for transcripts or VOEs, and you're also cutting those conditions. So for me, this one is a win-win. And like Sean mentioned, this product is priced just like our full doc product.
Cecilia, if I may,
exact same pricing, whether you would go full doc or asset only.
I think 2 questions in here that many people might be asking. I think Sean just answered one, so it popped off my screen. So let me re-get it again. Something about how many months of bank statements, I think it was. So it's 6 months statement season assets here. We don't need 6 months worth of statements. We need the most recent month statement and then the one from 6 months prior. So you don't need to get all the ones in between. And what underwriting is going to look at is the balance 6 months ago and the balance today, seeing if they're similar, assuming market movement, right? Which in today's world, right, could be pretty significant. If it goes down, you definitely don't have a problem. If it goes up, we're looking again for, an acceptable market movement there to make sure there isn't a big portion of new assets coming in to play. Another question, I think 2 kind of touching on the same thing from Nikki and Ernest about verifying the household expenses, etc. I like the easy way to solve for this for the 60 months, what we're looking for in the 60 months in, let's say, loan officer speak, is look at your 1008 and get your total liabilities on your 1008. That's it. Take the number off your 1008 and times it by 60. And that's the number we're using in order to calculate those 60 months. Nothing crazy on top of that.
Yes, exactly. It's a very, very easy calculation. We do have a worksheet where we plug in all the numbers. Most of us already know what to look for exactly, the three things that we're looking for that 60-month calculation, but it's very, very easy. Most of our borrowers do qualify, but again, you need that $500,000 in post-close assets, meaning it's not part of the down payment or the closing costs. It's something that you have left over and you're going to use. And that's really the whole basis of the product, is to say you're actually going to live off of this money, right? So we don't want it to be touched or commingled with that down payment.
And I don't know if Sean hit on this or Cecilia, but like, if you're not sure, right, on how to do our calculation, you know, I have a team that does that, right? You just got to send your AE the bank statements, the first and the 6 months ago, or even if you just want a calc, you can just give us the most recent and we'll do the calculation for you and shoot it back to you.
Exactly. The same non-QM team that does the bank statement review does the asset review. So if you need that done, just get with your account executive, get with Sean, and we will do it for you. Okay. All right. So moving on to our DSCR product. And we actually have two DSCR products. They have a lot of the same guidelines, but parameter-wise, it's going to be a little bit different. So our DSCR products are called SmartVest and SmartVest Platinum. Okay. So there's going to be a little bit of difference there in terms of pricing, in terms of down payment, but our minimum down payment on our SmartVest product is actually only 15% for a seasoned landlord. Okay. Now we've got another product that requires 20% down. That's our SmartVest Platinum. And things are going to be a little bit different there. Sometimes pricing is a little bit better. So we have those two options, right? But the minimum down payment for a seasoned landlord is 15%. Okay. For a first-time investor, which is someone that doesn't have that landlord experience, right? And landlord experience, we're looking for at least 1 year of landlord-tenant experience in the most recent 3 years. If you have that, we will say that you're a seasoned landlord. So if you're a first-time investor, you don't have that 1 year of experience, right? All you own is your primary home. If you're a first-time investor, we still allow you to do a DSCR investment purchase, and you need 25% down. Okay. Now, the other thing that we look at, aside from what type of borrower it is, whether it's a seasoned landlord or first-time investor, is we look at what type of rents you're going to use, right? The rents is the meat of the product. That's what really tells us if we're going to be able to get it done, what the DSCR is. So it used to be that you had to wait for the appraisal to come in. You had to wait for the appraisal and the 1007, and then 2 weeks into your contract, then you know if you've got a deal or not. But we've actually made it so much easier to get all of this done up front. So we use something called an AirDNA report. And it's actually linked to the two biggest short-term rental platforms, Airbnb and VRBO, Vrbo, right? So it's actually gathering data and information from those platforms based on your home, on the bedroom and bathroom count, and the city or the zip code that you're in. So the moment that your borrower calls you and says, hey, I just put in an offer on this property and, hopefully I get it and we can do this investment purchase. What you want to do is you want to reach out to your account executive. You want to give them that address, let them know the bedroom and bathroom count, and your AE is actually going to pull an AirDNA report for you. That report is going to give you a projected amount of short-term rents. It's actually going to tell you, hey, this is how much you could earn on this property. It can be, $90,000 a year. It could be $50,000 a year. It's going to give you a yearly figure. You just take that, divide it by 12, and that's your short-term rents. So we do allow you to use that. And the beauty is that you get that report the same day that your borrower gives you the address. Okay. The only thing is, and you'll see that on the bullets there on the left-hand side, when you're doing short-term rents, your down payment is going to be dropped just a little bit, right? So for a seasoned landlord, instead of 15% down, you would go to 20% down on short-term rents. Now, for a first-time investor, regardless if it's long-term or short-term, it's always going to be 25% down, right? And then depending on the borrower that you have, seasoned or first-timer, the DSCR is also different. So first-time investors, we want to meet a DSCR with a little bit more profit, 1.15, right? It's their first experience. We want to make sure that they're making money on it, and hopefully they like it. They like being a landlord. With a seasoned landlord, we do just want to at least meet the break-even point, which is a 1.0 DSCR. Or we actually allow them to go below a 1 to a 0.8, as long as the down payment is a little bit larger at that 30% mark, right? But there's different variants there, just depending on the down payment, depending on the type of borrower, all of that, right? But the beauty of it is that DSCR allows you to use short-term rents to qualify your borrower right off the bat, right? And that's going to be your worst case scenario. Once that appraisal comes in and we get the 1007, if those rents look better, you can actually switch to long-term rents if you like, right? At no additional cost or anything like that. It's actually allows you to use a higher LTV and the pricing is better. But you get the short-term rents, that projected income, immediately, same day. You don't have to wait for the appraisal. So that's one of the big draws of our DSCR products, are that we use an AirDNA report. And we give it to you. It's free of charge. We give it to you as long as you give us that address. We'll pull it for you, right? And you still get all the other little bells and whistles with the DSCR products. You can still close in an LLC if you like, right? The typical vesting closings are to close in the name of the borrower or to close in a trust. This one gives you the third option of an LLC. And then additionally, when it comes to financing, I think that's another really big draw to DSCR, is that yes, we have fixed financing options. We've got ARMs, but the most popular one for DSCR is interest only. And you get to qualify on the interest only payment. So that right there also gives you an easier way to meet the DSCR, right? And we've made it even easier for borrowers that are putting in, as much down payment as possible. You don't have to provide reserves for any of the other properties that you own. You only have to provide reserves for the subject property. So if you've got, maybe 10, 15 properties that you own, you're a seasoned landlord, you don't have to worry about reserves for any of those. You just focus on the subject property. And this product also, these two products, depending on the state that you're in, if it's eligible, you do have prepayment penalty options. So you can either opt for no prepay, or you can do a 1-year prepay, 2 or 3-year prepay. Okay. So we've got two products. And again, the down payments or the LTVs are going to differ on both, but pricing is also going to differ. Okay. So you definitely want to take a look at that. Sean, I know that you use the SmartVest product quite a bit. Do you want to speak on it a little bit?
I do. And investors last year, they've made many different moves, whether it's doing multiple cash out refinances to purchase another property or just adding more properties to their portfolio. If you run into that situation where the investor is doing multiple cash outs to purchase, we can do all of those loans at the same time with the same underwriter. This is a huge benefit that we have, that we can utilize the same underwriter and get everything done at the same time. In addition, a lot of those tools that Cecilia mentioned, I use them on a daily basis. Market rents are coming in lower in some instances, or, it's just not hitting the debt service we need to meet. So utilizing our interest only, we're able to do the qualification on the interest only payments. So that helps alleviate some of that stress. And I've actually used the short-term rental as a backup to that. If the investor wants the property and they have the money to come with an extra 5% down, flipping it to short-term rental, I've been able to get it qualify there. So it's utilizing these tools that if the market rents just don't come in, we're able to, really switch channels and go in a different direction to make the loan work. And a lot of investors like the interest only, so they can maximize their cash flow. And I do want to mention one thing that had also been huge. If you're in an area that has condotels, the fact that we can go up to 85% LTV on a DSCR with a condotel, no one else is doing that.
Yeah. Yeah. Jevon, do you have any questions on there that you need to address for DSCR?
I've been firing them off here rapid fire via chat. I think there's a couple about first time investors and what, kind of how we define a first time investor, and that is ownership in an investment property for at least 12 months within the last 3 years. So there is some leeway there if the property was sold in that 3-year time. So that's how we document that. We look at, we try and figure that out ourselves, right? Looking at third party reports, like from Data Verify to see that. And then we're looking at your application and trying to tie any open mortgages to the credit report. So we try and do that ourselves. Some of our loans get submitted to us with scheduled real estate owned or an explanation for their investment experience. That's always helpful, not required, but it definitely will help your underwriter breadcrumb to what you're looking for. A second question was about AirDNA for DSCR. We do offer AirDNA for both purchase and refi in our short-term rental product. It's its own product. And what I will say from a call out is on a purchase, we just use their DNA report. On a refi, you need to have a 12-month history of renting the property short term. So you'll use the AirDNA, and you also need to give us something from VRBO or property manager, whatever you got, something third party to show the history there.
Yes. And Jevon, one of the common questions that I get for seasoned landlords is if they own a unit's property and they live on that property, they live in one of the units, but they rent out the other, let's say it's a 4-unit, they rent out the other 3 units. And that's the only property that they have, but they've been a landlord for those other 3 units. Does that count as seasoned landlord history?
Yep. We can consider that. That's a perfect example where helping us see that, right? Versus just looking at a property on the application would be helpful. Save yourself a condition, draw that up out front, give us something to tell us that so we can validate that.
Perfect. Great. Thank you. So these 2 products, SmartVest and SmartVest Platinum, again, these are our 2 DSCR products. You are going to be able to work with U.S. citizens, just like not permanent residents. Permanent residents have to have a valid green card, right? Because these are investment. So if you have a non-permanent resident who only has a work permit, you're only going to be able to work with them on primary homes. So the other products that we went over, our full doc product, our bank statement product, and our asset qualifier, that's where you would be able to work with non-permanent residents who have a work permit. But here for investment, it's got to be a U.S. citizen or a permanent resident. Now, on one of our products for DSCR, which is our SmartVest product, we actually do allow you to work with a foreign national. So if you're looking to expand your database, right, and go international, then you can actually work with a foreign national on DSCR. That's going to be on our SmartVest product, not our Platinum product, our SmartVest. So foreign national is actually someone who is a citizen and resident of another country, right? They don't actually live here in the United States. So they may live in Spain, they may live in the Philippines, they may live in Mexico or Canada, right? Wherever they live, but they do not live here in the United States. However, they want to purchase an investment property here. We do allow that through DSCR. A foreign national does have to pass OFAC, right? You have to check the OFAC.gov website for sanctioned countries. You want to make sure that they are not from a country that's sanctioned. And there is a small list there, maybe about 12 to 15 countries that we cannot do business with. So you want to make sure you check that. And you want to make sure that your borrower has a valid passport, because at some point, they're going to have to come into the United States and sign at a title company. However, for a foreign national, yes, we want to see a credit report. An international credit report is fine, Canadian credit report, or credit references. But we don't actually need a credit score. We do want to see at least 30% down, right? So 70% LTV, that's the max. We're going to be able to do a purchase or a rate and term, but we cannot do cash out. So it's got to be a purchase or rate and term. And all they have to do is break even on that property. They just have to meet a DSCR of a 1. That's it. They don't actually have to earn money on it. When it comes to their assets, we're a little bit more lenient than most when it comes to assets. They don't actually have to have the money in a USA based account. They can be foreign assets from their country. It's absolutely fine. What we do want to make sure is that if they are using those assets, that they wire them over to the title company and that they stay there for at least 30 days in order for us to get that money seasoned. And that's typically the duration of your purchase contract period. So I would say if you do get a foreign national and an offer gets accepted, get that money sent over to the title company immediately. And that's going to be your 30% down and 12 months reserves. A foreign national does need 12 months reserves. Okay. And really what we're looking for is to make sure that this borrower owns a primary home in their country where they live, right? They have to own a primary home. They can't be a first-time home buyer. They have to already own their primary home. So whatever you can provide to that effect, whether it is seeing some sort of mortgage statement, property profile, tax sheet, something like that for the property that they own. But remember, everything has to be translated into English, right? And it does have to be certified translated in order for us to be able to read it and use it. You're not going to be able to turn in something maybe in Spanish, although a lot of people may speak Spanish, in the teams. We're not going to be able to accept it. We might be able to say, yeah, this document looks good, but you have to get it translated. It does have to be certified translating. Okay. So if you have a foreign national, yes, you can do DSCR on our SmartVest product. And again, just 30% down. Sean, have you done any foreign nationals recently?
I have. And, there's a few more hoops to jump through just because of the qualification purposes, but we're still getting them done. We're seeing a lot more people. The biggest one that we're seeing right now, and unfortunately we can't do, is anybody from Venezuela or in any of those countries on the non-sanction list. But yeah, a lot of Canadians are coming in and buying investment properties. We're seeing a lot from there. And yeah, they're going right through and just as easy as regular DSCR.
Okay, great. Any questions for that, Jevon, for foreign nationals?
Let's see.
Looks like there's one from Ben.
Sorry, I can't find my thing.
The reserves, he's asking if the reserves can stay in their foreign account. Unfortunately, no, we need all the money for the transaction, down payment, closing cost reserves to be in the US account. Either US account for 60 days or with title for 30.
Yes.
Spot on, Sarah.
Yes. So if they do have a foreign account and they don't have an account here, then they should wire it. As soon as you open your contract, as soon as you open title, you want to have them wire all of that over so that you won't take longer than your 30 days, which is your typical contract period, right? You want to send everything over and it's going to get seasoned there for the 30 days. Okay. Anything typical that you see, Jevon, with foreign nationals? Like anything where people get hung up or kind of miss something that they didn't realize that they had to meet?
Yeah, the foreign nationals, the biggest one that we run into is the assets. Because there can be a tight timeline and usually they're sitting in the bank in a foreign account and we got to wait those 60 days. So that's the biggest holdup on these.
Yeah. Yeah. So it's a good idea if you have a foreign national borrower to get that money wired over to title as soon as you get that contract accepted, right? And again, that's got to be your down payment, your closing costs, and the reserves. We need all of that money. Now, if they do have a USA-based bank account, it's fine. We can just get it seasoned through there. But if they don't, and they're going to use their foreign asset, you want everything wired over to title. It's going to remain there for the 30 days of that contract period. As soon as it reaches 30 days, we can close. So that's a really good way to expedite the closing and not have to hold things back. And again, remember, once you turn in those statements or anything in terms of verifying where they live or their primary home, things like that, you have to get all of that translated into English, and it does have to be certified translated. Okay.
Hey, Jevon, I see a question up here. If we can use short-term rentals for foreign nationals. I can't answer that. I don't believe we can, but
Yeah, that was a good question. That's actually the one
It
I'm
was.
looking up right now. but it's not something we come across very frequently. So I'll get back to them on that.
So typically, no, for foreign nationals, we don't use short-term rentals. We use only long-term rents. There is a different grid and product for short-term rents. So foreign nationals is just going to be your typical 1007 market rents.
And I want to mention something real quick that the interest only, it's not just for the DSCR. We can use it for any of our non-QM products. We can either do a 30-year or 40-year IO, which is a 10-year interest only period with a either 20 or 30-year amortization after that.
Yes. When it comes to financing, we do offer the interest only at a 30-year term or 40-year term on all of our products. However, DSCR is the only one where you can actually qualify on the interest-only payment. For the other products, whether it's full doc, asset-based, or bank statement, you would have to qualify on the fully amortized payment. Okay. All right. If there's no other questions, we're actually done with the 5 products that we wanted to present to you today, which is our full doc product. And actually, I'm going to go back to that page just to give everyone that little review. We've got our full doc SmartEdge product, right, where you can use pretty much everything that you're already used to using on the conventional side. We've got our SmartSelf product, which gives you 2 additional options for self-employed borrower using personal or business bank statements or 1099s if they're a contractor. We've got our all asset-based product, which we call asset qualifier, no debt ratio, no income. And then we've got 2 DSCR products. One which we call SmartVest and another which we call SmartVest Platinum. Each one of them is going to give you a little bit different LTVs and down payments, and pricing is going to be different as well. Okay, and if you want your foreign nationals is going to be on SmartVest. But when you're doing DSCR, it's really about pricing and then talking it over with your AE, going over the scenario to see which product is best going to fit what your borrower needs. Okay. So I want to thank everyone on the panel, Jevon, Sean, everyone, Tony, for helping us out today. And also thank everyone for joining in today. Any other questions that you have that we were not able to answer on the chat, we will get back to you. Again, an account executive invited you to this. If you're not sure who that is, drop us a message, drop us a line in that Q&A section, your email, your company name. We'll get back with you and let you know who your account executive is. If you don't have one, we'll assign one to you. But we want to thank you for joining us today and just learning and understanding that Newrez is not just agency products. We are also non-QM. We are the lender, the investor, and we are also the servicer to all of these products. So thank you, everyone. Appreciate your time.
And your AE will have the information about your 25 basis point coupon that you can utilize for a locked loan by the end of March 31st.
Yes. Thank you.
Thanks, everybody.
Thanks, guys.
Bye.